Hi everyone, today we're going to talk about registered plans. When I ask people why they invest in registered plans, most will answer they do so to save taxes. And in fact, they may or may not be saving taxes over time. What they are often doing is they're deferring payments, especially when you talk about an RRSPs. But the thing is, we don't know what the tax rate is going to be in the future. If taxes go up, then they're going to lose. If taxes go down, then of course they're going to win. Any contribution above a company match is a tax risk. And the deferral of tax payment is just an apparent benefit because we don't know what the future tax bracket is going to be. Now, as you can see, there are many different types of registered plans. We have RRSPs, TFSAs, IPPs, RRSPs. We have the whole alphabet here. Quite a few, right? Now, let's start with an RRSP. When I ask people why they invest in RRSP, again, a lot of times they say they're saving. What they're actually doing is they're actually deferring the tax. But let's actually look and see what RSPs actually do. Specifically, they do two things, right? They defer tax, but I like to say they actually postpone the tax. I think that's more reflective of what's happening here. And ultimately, that brings up two other things. If we're going to defer the tax, the two things we want to consider is, what will your tax rate be at retirement? It's going to make all the difference. If you postpone it to a later date, what's the tax rate you're going to pay at that point? That's going to be super important. What tax bracket will you be in retirement? What do you think is going to happen in the future? Again, this is all an educated guess, but it's one that you have to at least consider because it's going to impact the future of your net retirement income and how much you're going to be able to spend. Okay. Next thing we have to consider is what deductions will you have when you take money, when you take the money out in the future. Well, most people take their deductions during their working years and have very few during their retirement years. House is paid off, kids have moved out, you're probably retired, or if you're working part-time. But most people take significant more deductions in early years. So with that in mind, one thing we could kind of look at the tax thresholds, and here are the tax thresholds from 1985 to 2002. So this kind of gives you a sense of, what has happened historically. Let's look a little bit at tax history. You can see here different way income was being taxed over the last little bit. So again, with RSP, two things to consider. Well, first thing you have to know is that you're postponing your tax. Two things to consider is what tax rate will you be in retirement and what deductions you'll have when you go to get that money, right? Now let's kind of use some numbers to get a sense of things and how it works. So here we have an annual contribution of $10,000, current tax bracket of $30,000, withdrawal bracket of $30,000, years until withdrawal $30,000, and let's say an investment return is 6%. Again, we're gonna be messing around with the numbers. I don't want you to get locked into the numbers. More so, I want you to consider what happens based on how we move the numbers around, so you get a sense of what happens with the RSP versus the TFSA and a non-reg, as we'll go through. So if you're putting $10,000 in an RSP for 30 years, you think you're gonna have $838,000. However, that's not quite so. Essentially, your share is only $586,000 approximately. CRA, however, is going to get $251,000, just roughly. Let's run them out there. All right. Now, in the example, you deferred $3,000 every year of your $10,000 contribution. But what people often miss is that they wrote a check for $10,000 to put $10,000 in the account, but only $7,000 was theirs. The $7,000 is obviously going to grow at interest. The $3,000 is also going to grow at interest, but it's going to grow at interest for the CRA. So, before I go further, the one thing you want to also look at is that apparent tax deferred. Because that's pretty important. The apparent tax advantage for putting in a qualified account and deferring the tax to a later date is $90,000. The apparent tax saving is $3,000 a year over 30 years, and that's actually $90,000. But the CRA doesn't want $90,000; they want $251,000, which is $3,000 a year at interest. Now, what if we increase the withdrawal tax bracket? So this is when you go to withdraw money if your tax bracket's at 40%. I want you to look at the numbers now, and let's see what happens when we calculate. Numbers increase. So that's what happened if, when you have a current tax bracket, so at 30%, and then at a later date you increase that amount. It increases here. So that's what you need to consider, that yes, you're deferring that income, but what you should also know is that you're potentially going to pay more if you're in a higher tax bracket. Okay. Now let's take a look at how tax bracket affects returns. And again, I want you to focus on not the exact tax brackets and the percentages, but I want you to get a sense of what happens at the different withdrawal rates and the different contribution rates, right? Okay. So let's say we have annual contribution of 10K. You know what, for now, let's say we have no annual match. Let's go without annual match to start. Say the investment return is 6%. Say the tax bracket for first 10 years is, let's say, 30%. Yeah, let's just keep everything at 30%. Here's someone they're going to earn 6%. We're going to look at 3 10-year periods. Let's say they were in a 30% bracket all the way across. Now you would expect a return of 6% each period, right? Makes sense. Now, what if we change the inputs, and what if we made this 10%, then this 20%, and then the third is 30% with a withdrawal of 30%. Now look, this is not how we started. Let's say they were in a 10% bracket when they started, so like we see here. Then they were in a 20% tax bracket, and then finally in the last 10 years they were in a 30% bracket. When they withdraw, they're one of the fortunate ones that can take the money out at the same bracket they were in when they were working. What's that do to returns? As you can see, it drives the returns down. Now, what happens if they were in a 40% tax bracket at the very end? What if we made this 40%? When you look at this, do you think it's a great place to be putting your money or not? Now let's look at an example if they have a company match, because as you can see here, you get a sense that different withdrawing at different time periods affected significantly, and quite frankly, having a higher withdrawal rate at the end leads to, 4.23%, even though the investment return was 6%. Now let's see if we do some government match, how that will turn out. So the annual contribution is 10,000. Let's do a match of 5,000. Okay, so that's 50 cents on the dollar up to 5,000. Investment returns, let's keep that at 6%. Tax brackets, that's 10, 20, 30. Let's have the withdrawal be 30%. If they're trying to earn a 6% return on their contribution with the match and the lower early brackets, that match helps to improve the final rate of return, as you can see. In this example, the best years to contribute to this plan was in the last 10 years. Okay, so it's the last 10 years, but why? Because the tax brackets are the same. However, if you go to a 40% tax bracket at withdrawal, obviously, what do you think is going to happen? It's going to decrease the effective rate, right? So again, it's 6.3 with 40%, 7.17 with 30%. So any contributions above the match are likely to suffer reduced returns due to the tax brackets. Right? Now what if we change the match back to 0? 4%. Right? So hopefully you're getting a sense of this and what's happening here. Now, how do RRSPs compare to TFSAs? What if I told you that RRSP savings will net the same retirement income as TFSAs as they grow and as they're withdrawn tax-free? All right, let's kind of play with some numbers so you get a sense of that. So if the annual contribution is 10,000, current tax bracket is 30,000. Let's leave that there. Withdrawal tax bracket 30,000. Let's leave that. 30%. We'll leave that. Investment. Okay. Let's do some calculation. So if you put pre-tax money in an RSP, you defer the tax and you have a taxable withdrawal. At a 10,000 a year, your account grows to be 838,000, as you can see that here. You're going to owe the CRA approximately 251,000, and you're going to net 586,000. On the other hand, if you put after-tax dollars, again, the big emphasis is after-tax dollars. That means you have paid taxes on it. Put after-tax dollars in an account that has a tax-free withdrawals, you'll end up with essentially the same amount. Right? So if you're putting, remember, if you have that $10,000 essentially, or you're putting in that tax-free savings account, the $7,000, and you put it in a tax-free account, that will grow to be $586,000. Now let's compare an RSP with a taxable account. As you expect, the RSP has an advantage of tax deferral, where tax account suffers from tax payments each year. And when we talk about taxable accounts, we talk about non-registered accounts. Right? So if you just have an investment in an open account, that's what we call a taxable account or a non-registered account. All right, so let's look at these numbers. So if we start off account balance 0, annual contribution 10,000, company match is 0, current tax bracket is 30%, withdrawal tax bracket is 30%. So let's leave that. Years until withdrawal is 30 years. Investment return 6%. Okay, good. Let's do some calculation. All right. When you look at these results, you would think, I would choose to save in an RSP plan because it will outperform a taxable account. And that's true. It most likely will. So, that kind of gives you a sense of numbers-wise, how this will all, play out. Now, like the last screen, if we could change a taxable growth to a tax-free growth, the results will be the same. See that? The RSP, same as the TFSA. So again, the tax-free growth and withdrawals can end up essentially the same as an RSP, but it all depends on the tax brackets. And if the tax brackets are higher when withdrawal than a tax-free account, again, let me see, percentages. Okay, so if we increase this, so again, if the tax brackets are higher when you withdraw, a tax-free account is better. So that kind of confirms what we spoke about before. So in conclusion, if you choose to save money in an RSP, there are 3 important questions you need to be asking before you do so. What's the first one? What tax bracket you will be in retirement? Your future tax bracket should affect your decisions you make today. 100%, that's something you should be considering. Next thing is, what deductions will you have when you take your money? It's important that we answer this question. If we can put you in a position where you do have deductions when you're taking the money, then that's quite significant. That's where tax planning comes into place. And then finally, what is your exit strategy? How are you going to get the money out without paying all the taxes, right? And this is where tax planning is very important. Hopefully you have learned something today. A lot of times we use these accounts, and sometimes clients don't have a sense of how they work, and what's the difference if we put a TFSA and RRSPs or non-reg. Hopefully this provided you with a bit of enlightenment. And if you like this content, please feel free to like, share, and subscribe. If you have any questions, feel free to contact me below. Have a great day. Thanks.